Hello and welcome. I'm Owen Dwyer, Equity Portfolio Manager at Fineco Asset Management. Today, I'd like to talk to you about the overall equity market outlook for 2023 and one of the funds I manage, Global Equities Income. The equity market has started 2023 strongly after a weak 2022, driven, we think, by a combination of four factors. Firstly, very negative sentiment and defensive positioning, and data being released has been mixed. It hasn't been as bad as feared, and this has been a positive for investor sentiment and supportive of short covering. Secondly, China reopening has proceeded much quicker than expected, which is a positive for global growth. Thirdly, easing energy costs in Europe as a combination of milder weather and energy saving measures have come through, and this is a positive for European company margins. Finally, expectations that central banks are getting close to the peak in interest rate rises and hopes that we will see cuts in the middle of the year is supportive of markets. So where to from here? In summary, we think 2023 will be a volatile year for equities, with sizable drawdowns and reasonably large counter-trend rallies as sentiment ebbs and flows and fundamentals and data swings around. If we focus on fundamentals and start with valuations, what we can say is that at an overall level, the market is now pricing in a gradual easing in inflation and a slowdown without a recession. That would be an excellent outcome, and it would be a great result were it to happen. However, given all the uncertainty, we believe it's appropriate to hope for the best but plan for the worst. This is why we think it makes sense to focus on those areas of the market which offer a combination of the most attractive valuations and quality business models. Within this environment, we believe the Global Equities Income Fund is well placed to weather the volatility and to prosper for a number of reasons. Firstly, this is an income fund, so the dividend yield is meaningfully better than the dividend of the market. Currently, the dividend yield of the fund is 3.3%, which is about 70 basis points better than the MSCI ACWI Global Benchmark. This offers some protection against drawdowns. Secondly, the valuation of the fund in terms of price earnings, price to book, free cash flow yield is significantly cheaper than the market, by 20 to 30% depending on the metric, while the debt to equity ratios are lower than the market, while return on equity is meaningfully higher. In terms of the types of companies we include in this portfolio, typically they are industry leaders with solid balance sheets, strong cash generation that reward shareholders through dividends or cash return. That's it from me. Thank you very much for your attention.